Welcome to Nisab Finance. When people ask, Islamic banking versus conventional banking, which is better? They're usually asking a deeper question too. What kind of money system do I want to trust? One system is built around interest. The other is built around Shariah rules that avoid interest, excessive uncertainty, gambling, and financing harmful activity. At first glance, they may both help you save, borrow, and pay bills. But under the surface, they work very differently. And that difference matters. Islamic finance is no longer a niche idea. In 2024, global Islamic financial services reached about $3.88 trillion in assets. Most of that is banking, not just investing. So this is not a small side topic anymore. It is a real banking model used by millions of people. Let's start simple. Conventional banking is familiar to most people. You deposit money, the bank lends it out, and the bank earns money mainly through interest and fees. If you take a loan, you repay the principal plus interest over time. The bank's profit is tied to the price of money itself. Islamic banking works differently in theory. Instead of earning money by charging interest on cash alone, the bank must connect transactions to real economic activity. That could mean a sale, a lease, or a partnership. The contract matters just as much as the payment. Here's the key idea. In Islamic banking, the bank is not supposed to simply rent money to you. It should earn through something real. A common structure is murabaha, where the bank buys an asset and sells it to you at a disclosed markup. Another is ijara, where the bank buys an asset and leases it to you. Then there are partnership models like musharaka and mudaraba, where profit is shared according to an agreed structure. Islamic banks may also charge service fees through agency-style arrangements. So yes, the monthly payment can sometimes look similar, but the logic behind that payment is different. That leads to the biggest question. Is a profit rate just interest with a new label? Sometimes it can feel that way from the customer's perspective because the cash flow may be similar. But in Islamic finance, the contract's purpose matters. The bank must be tied to ownership, leasing, or partnership, not a pure loan. In other words, form and substance both matter. Still, there is an important tension here. In theory, Islamic finance emphasizes risk sharing. In practice, many products end up looking fixed and predictable, especially in home and auto financing. That is partly because customers still want stability and banks still need to manage risk. So even in Islamic banking, the ideal and the reality are not always perfectly aligned. This is where the trade-offs become real. Islamic banks often use asset-backed or asset-linked transactions, which means there must be something identifiable underneath the deal. That can make the system feel more connected to the real economy, but it can also mean more documentation, more review, and fewer product choices. Conventional banking, by contrast, is usually faster to compare. You can often look at the interest rate, the annual percentage rate, and the fees, then decide quickly. The system is standardized, widely available, and easy to shop around. That convenience is one reason conventional banking remains dominant in many countries. Islamic banking brings another layer, Shariah compliance. This is not just about the product name. It also involves governance. Who reviewed the structure? Who approved it? How is compliance audited? In many Islamic finance institutions, Shariah supervisory boards and compliance teams help answer those questions. Standards from groups like AAOIFI have made that governance more formal over time. And that governance matters because trust is the whole point. If a bank says a product is Shariah compliant, the customer wants to know it was reviewed carefully, not just branded carefully. That is why Islamic finance is not only about avoiding interest. It is also about avoiding excessive uncertainty, speculation, and prohibited industries. The bank is supposed to filter what it funds, how it funds it, and why. Now let's talk about how both systems actually make money from the customer side. In conventional banking, the model is direct. Deposit money, lend money, charge interest, collect fees. In Islamic banking, the income streams are different. The bank may earn a markup from a sale, rental income from a lease, a share of profits from a partnership, or a service fee. So the bank still earns money. It just earns it through a different legal and ethical structure. That difference shows up again in account types. Conventional banks usually offer checking accounts, savings accounts, and time deposits, with interest paid or charged depending on the product. Islamic banks often separate non-interest current accounts from profit-sharing investment accounts. In those investment accounts, returns are not guaranteed in the same way. They depend on the performance of the underlying activities. That sounds ideal in principle. But there is another real-world pressure. Customers often still expect returns that are competitive with conventional banks. When rates move in the market, Islamic banks can face what economists call displaced commercial risk. In plain English, that means the bank may sacrifice part of its own profit to keep customer returns attractive. So even here, the system is trying to balance principle and market pressure. Accessibility is another major difference. Conventional banking is available almost everywhere, with broad retail products and deep infrastructure. Islamic banking is growing, but availability varies a lot by country. In places like Malaysia or parts of the Gulf, it is mainstream. In the United States, it is much more limited. Many people only encounter Islamic finance through specialized home financing or niche banking arrangements. The important point is this: Islamic-style products can exist within U.S. banking law. Regulators have historically allowed structures like murabaha and lease-to-own home financing under certain conditions. So the challenge is not always legality. It is often scale, product availability, and convenience. That brings us to fees and pricing. Conventional banking often looks cheaper at first glance because pricing is straightforward. You can compare APRs, balance requirements, overdraft fees, and account charges. Islamic banking may have additional layers of documentation, review, or asset transfer costs which can affect pricing. Sometimes the difference is small, sometimes it is noticeable. And because Islamic finance is built on real assets, liquidity management can be complicated. Some widely used structures, like commodity muraha, have become significant in practice. In fact, they are so common that they have raised questions about whether some products start to resemble conventional debt economics too closely. That is one of the big debates inside Islamic finance today. Here is the honest truth. The label alone does not tell the whole story. A bank can call something Shariah compliant, but the quality of governance, the actual structure, and the level of scrutiny all matter. Likewise, conventional banking is not automatically bad, and Islamic banking is not automatically superior. Each system has strengths, limitations, and trade-offs. So which is better? The answer depends on your priorities. Choose conventional banking if your main goal is maximum accessibility, simple product comparison, and broad availability. It may be the most practical option if you need speed, standardization, and the widest choice of services. Choose Islamic banking if your priority is Shariah compliance, ethical screening, and a banking relationship designed around avoiding interest and prohibited activity. It may fit better if your values demand that structure, even if it means fewer options or more complexity. And if you are still unsure, ask 3 questions before you decide. First, what do I value most? Cost, convenience, or compliance? Second, is the product truly structured the way I believe it should be? Third, is this service actually available and usable in my area? If you answer those honestly, the choice becomes much clearer. So the real lesson is not that one system wins forever. It is that the right bank is the one that fits your beliefs, your financial goals, and your local reality. That is the comparison. That is the decision. And on Nisab Finance, we want you to choose with clarity, confidence, and understanding. If this helped, subscribe to Nisab Finance and comment what you're choosing right now.